Hello, this is Josh Belk with the Belk on Business podcast. Thank you for joining us again today for just a few moments. Today we're going to talk a little bit about some top bookkeeping issues or common bookkeeping issues that generally are seen out there as it relates to clients' books, maybe some of the way that they're handling some things internally. And as we approach through year end, last week's podcast, we talked through some tax issues. It was a lengthier podcast. If you're kind of approaching year end, I want to maybe hear some pointers on maybe some things you need to consider as it relates to taxes. I encourage you to go back to our episode last week and take a listen. Today, just going to point out maybe some bookkeeping issues that you may want to consider kind of looking at as we approach year end and as we prepare for 2024. And so maybe 1, 2, or 3 areas maybe you look at inside of your business as it relates to kind of the bookkeeping, internal finance side, and maybe some things you need to implement or change, or maybe at least having a conversation with a third party that you may work with as it relates to whether it's a bookkeeper or an accounting firm that may be helping you with some of these issues or handling these issues for you. So just 10 just kind of common bookkeeping issues that generally are seen as it relates to and this is generally true for smaller businesses as it relates to primarily their books. First of all, proper invoice and receipt tracking. So when we think of invoices, of course, that's when you're talking about a money collection primarily. So you're going through and you're billing a client, or if you have a retail type business, or even a small service type business, to where you're not actually creating paper invoices, do you have some sort of documentation that's going to match the money that was received against some sort of internal document? So for one of my businesses, an accounting firm. And my primary business in our accounting firm, every single client gets an invoice and whether or not they pay us directly off the invoice or not, we generate an invoice and it goes out to the client for their records and for ours. And so we go through and it specifies this is the work that we did. Now it may be a situation to where you have a business. I have a daycare, for example. Okay. Some of them, they want to pay off an invoice. Others, they come in and they just pay weekly. But even still then, there is a document that is given to them. So when they come in, there is literally a receipt that's handed to them. If you think about what kind of those old receipt books, to where when they go in and who the customer is, who the actual, in this case here, who the child is, what they're paying for, and then the amount that's received, and that would essentially get held internally, reflecting this is the amount of money that was received, the services that we're offering. So in a case where there's an audit, all the cash that was received, there's a corresponding document that gets attached to. On the flip side, the same thing is going to be true for any expenses. Now, sometimes you end up in a situation, and I've heard this before, well, the IRS has a $75 receipt requirement. If under $75, it doesn't require a receipt. Therefore, they don't keep any receipts, okay, for under the $75. Not a really good habit to get into, okay, even though there may be some forgiveness there. If you end up in an audit situation, I was in an audit scenario earlier this year with a client. And because they were so egregious with not keeping receipts for items over $75, the IRS ended up stepping in and really beginning to question whether or not those areas that the receipts were not necessarily required, that they essentially were going to disallow some of them as well based on some of the other criteria. It is generally my suggestion, regardless of the amount of the receipt, that receipts are kept. So, and I'll get it in just a moment here, talk a little bit about reimbursed expenses. But so any money that's spent, there should be some sort of a receipt. Go to the gas station, get a gas station, get a receipt for the fuel. Whatever the case may be, you're purchasing from a vendor, make sure you're paying off some sort of a invoice, a bill of sale, some sort of purchase, or you have something that can attach essentially the disbursement to. And of course, nowadays when we talk about electronically, a lot of times that information can get stored electronically, whether it's attached inside of your accounting software, inside of your email, whatever the case may be, but you're a place where you can go and pull those receipts. So all the money that's received inside of your business should have a corresponding invoice or some sort of a corresponding receipt. Same thing is true in all the money that is spent. There should be some sort of a corresponding document that gets attached to, and all of that should be kept. Timeline for for keeping those documents under IRS rules, 3 years from the time that your tax return is filed. Okay. If you're committing fraud, it's indefinite. Okay. I generally recommend that you have a good document retention policy and one that is followed. So if you end up going into a situation to where you're only required to keep those receipts for 3 years, and then something were to happen, you can say, hey, according to our document retention policy, it states 3 years. We only keep them for 3 years, but you need to follow that policy if you're going to hold to that particular standard. So, and then as I've talked about in previous podcasts, some things, for example, if you own properties, any sort of fixed assets or whatever, you're going to want to keep those documents for at least 3 years until after that particular asset is either sold or the depreciable timeline has run out. So next, handling expense reimbursements. So this is another area, so it's a real big problem. Sometimes you go through and you allow for employees to go through, maybe they're using a company credit card, something to that effect, and they're not handing in those receipts. Okay, you need to have some sort of a policy internally. So first of all, when it comes to if you're giving team members credit cards, for example, and for the accounting firm here, there's two other of our team members, and when they go through and they spend, and they're phenomenal about coming in and making sure the receipts are filed, but that's not always the case, especially we see this a lot in the construction business, things of that nature, where they go through and the money gets spent and the receipt just end up getting put somewhere. Okay, make sure that you have a good policy in place. Make it easy for the team members to be able to capture those receipts, whether it's taking a picture, sending them to the office, whatever the case may be, to where the receipts could be kept. If you are allowing for employees to go through and purchase something and they're going to get reimbursed, you need to have an accountable plan or accountable reimbursement plan inside of the business, where it specifies the rules as to how the money can be spent, and then in regards to the reimbursement, what does that look like? I have a prior podcast that goes into a deeper dive into this particular topic as it relates to accountable plans. But if you are in a situation where you're reimbursing employees, you really should have an accountable plan that provides that policy as it relates to how you are reimbursing your team members or your employees. Number 3, proper classification of employees. And once again, it's another topic we've talked about a number of times on previous podcasts. Is somebody an independent contractor or are they truly an employee? Make sure you understand that. It is an area that does get looked at more at the state level than the federal level. But if you end up misclassifying employees, those penalties, misclassifying employees as contractors, then those penalties can be quite severe. Make sure you have a good understanding of what those rules are, and then making sure that you're applying them appropriately. Next, not doing at all monthly reconciliations. Okay, so when you talk about our monthly reconciliations, and this generally should be policy generated as well for your internal team. And so who's doing the reconciliations? How many days after month end are you doing these reconciliations? So every month, people think, okay, bank accounts, they need to reconcile bank accounts. And so that gets done a fair amount of the time. What many times gets missed are credit card reconciliations, and what almost categorically always gets missed are kind of those other balance sheet reconciliations, such as escrow accounts, etc., mortgages. And so many times those are not getting reconciled out. So everything that's on your books, when we think about bank accounts, when you think about credit card accounts, any sort of escrow accounts, mortgage accounts, etc., all of those should be reconciled monthly. You're looking at the statement and making sure that the books are reconciled out before you provide your monthly financial reports to whomever they're going to. So if it's internally, you have a bookkeeper, all that needs to be done before you as the business owner receive those reports. You have an outside a bookkeeper, an outside firm you're working with that handles this. Make sure you're getting them that information so they can handle those month-end reconciliations. So when you get your financials back, it's an actual document that is usable. Next, number 5 here, data handling, and this has to do with backups. Early on in my career, we had these big, huge, disk or cassettes that we would essentially back up the server every night. They would go off site. We had, there were so many of them kept in a secure place. So we had this whole kind of process that's built. Nowadays, most all the data is online. But that being said, you should still make sure that data is getting backed up. And so you have some sort of a policy as it relates to what are we backing up, how frequently are we backing up that information. Many times it's not necessarily required to get taken off site if it's on the cloud. However, However, if you're keeping things in one place, it should be periodically getting backed up to another. So just in case something gets hacked, something goes down, whatever the case may be. And so as we know, even some of the largest companies can get hacked. It could be your data that gets compromised. So to have that information in another place as well is a very prudent thing to do. So make sure you understand where's your data at, who is storing it, and then how can I go about extracting that data so I can keep a backup of it in another place. Number 6, understanding sales and income tax issues. Nexus is a big issue right now. And it has been. So every state is kind of looking for their sales tax or their income tax. So understanding where you're operating, where do you have employees, do you have a potential issue as it relates to either sales tax or income tax in that particular locale. So if you have an employee in a particular location and you're collecting sales tax, it may be a situation to where you might have both income tax and sales tax in that state because you have an employee located there working remotely. You say, I don't have a physical office there, but are you conducting business there, either directly or by proxy, meaning an employee or otherwise? And so make sure you understand what those state rules are and that you're operating accordingly. Next, handling of petty cash. Number 7, handling of petty cash. This is not as big of an issue as it used to be, but if you have any sort of cash on hand, making sure that if you do have petty cash, that there's a petty cash register, it is getting reconciled out periodically. If you have a retail store, okay, so if I were to go into my local, Walmart, for example, that particular register is getting reconciled out frequently. And so if it is one of those situations, if you have cash on hand, that petty cash, okay, that cash register, or it may not even be money collecting from clients. It may just be petty cash there where people can grab money to go and instead of them having to go and get a check written or get credit card authorization, something to that effect, where they just pull money out of the petty cash. That there is a reconciliation. Who's taking the money? How much was taken out? And how is that getting petty cash drawer getting essentially reimbursed with cash to get it back up to a certain level. So if you have a petty cash with $100 in it, somebody goes through, they take $40 out. That person needs to write down, this is how much they took out. This is who took it. And then when they come back with the receipt, the receipt goes back in, and then the amount that they put back into. So they take $40 out. They only spent $36. They take $4. They put it back in the petty cash drawer along with the receipt. That needs to get reconciled out in all probability daily, at least at minimum weekly, depending on the frequency that particular the petty cash is getting used. If you have a petty cash that's getting used regularly, it's going to be a situation to where it probably is going to be daily. Next, number 8, too few or too many accounts. And this is true whether it's checking accounts. I can't tell you how many clients are utilizing kind of some of these hacks, creating all these different types of checking accounts. They don't get used properly. They don't do the allocations. They don't do these types of things, and it just ends up really creating a headache. You end up with this money movement all over the place, and so the movement to money is an emotional experience. Okay, it does nothing to help your business. It's just purely an emotional experience. If you don't have the discipline to be able to utilize the accounts and you aren't utilizing properly, why are you going down that road? So having too many accounts. This is also true with your chart of accounts. We sometimes see books where they have vendors as expense accounts and this type of thing. There is a better way. Okay, so it's kind of one of those situations to where you really create an absolute nightmare for you trying to read your financials, understand what's going on, your internal team trying to keep up with it, or even your external, if you're using an external bookkeeper, for them trying to keep up with, okay, I have a vendor that's also an expense account. Does it belong here? Does it belong there? And it not only does it create confusion, too long of a set of financial statements, but also it's just a situation to where it just ends up just a higher probability of miscategorization of transactions, and then just so much detail that it simply just cannot be understood. So generally, keeping it simple, stupid, okay, is a good way of going about as it relates to your financials. Also, don't make them where you have too many chart of accounts to where everything is an office expense, for example. So postage and advertising and everything else gets wrapped up into it. That's kind of going the other direction. So find that good medium to where it's functional, to where you can understand the financial statements, and then also to where your team can manage it and manage it well, to where they can go through and it's clear, it's understandable, and so it's not something that's overly complex. So keeping things simple, keep a small number of bank accounts. Where you may have a payroll account, you have an operating account, and maybe you have some sort of a tax or other savings type of account. Generally, that's generally a pretty good idea. I know for most of our clients, when we're suggesting, generally it is an operational account. It'll be generally a savings account as well, and then we have other processes it relates to payroll and tax and things of that nature to assist them. So next, number 9, handling bookkeeping internally without oversight or review. So if you do have an internal bookkeeper, making sure that there is a third party taking a look at those things, and so there is some sort of oversight, some sort of review process as to making sure that the bookkeeper is doing their work correctly, and also to minimize any sort of mishandling of the finances. Most of the time when somebody hires a bookkeeper, it is somebody who, it was a really nice lady that they knew someplace that they're hiring in and kind of maybe work someplace for a while, kind of handling books. They may not be the best at it. They're just kind of adequate. You figure, okay, well, I can pay this person $12 an hour, and they're going to do my bookkeeping. That's all fine and good. The problem is you're generally not going to get a really good product on the back end, but either way, you really should have some sort of oversight as to the work that is being done. So you, as the business owner, get a good set of financials with some sort of level of confidence that those numbers are relatively accurate, and that somebody else is taking a look at those numbers. Most businesses find it to be cheaper and also more helpful to have a third party handling this, somebody who is a lot more qualified in providing this particular service to handle this for them. Number 10, and lastly for today's podcast, last kind of common bookkeeping issue is not commuting internally with finance and leadership, or communicating poorly with your outside bookkeeper accountant. This I find to be probably the most serious of this entire list as it relates to just making sure that everyone is on the same page. And that's just simply a lack of communication. So when it comes to a situation to where, and we see this, to where you have leadership wants to have a meeting and they're completely beating up the finance team, it's just simply because they never expressed to the finance team, to the bookkeeper, what it is exactly they're looking for. What is it that you are wanting? What can I provide for you? And then constantly changing the goalpost, or looking at the bookkeeper and berating them because the numbers don't look the way that they want them to, and many times it's a performance issue and not necessarily a presentation issue. To make sure that that communication is there. Leadership is communicating with finance well. There's good direction. There's good communication. And then also as it relates to your outside, if you're using an outside bookkeeper, outside accountant, that there's good communication there as well. If something gets asked for, that information is exchanged, and that you're regularly communicating, so there's a good understanding as to what both parties are needing and what both parties are looking for, so they can help each other to be able to serve each other well. So the business owner has the information they need to make good decisions in their business, and that the outside party can understand exactly what it is that they can do to help, not just provide a good tax return or a good set of financials, but also to be able to advise well, and then also internally with the internal team to try to minimize conflict and confusion as it relates to the handling of the finances of the business. So just a list of just 10 common bookkeeping issues, and maybe there's one or two of these that maybe you want to take a look at and maybe consider implementing or making some changes to help improve your business. Once again, this is Josh Belk with the Belk on Business podcast. Hopefully this particular podcast did bring you some value. If you haven't subscribed already, please do so. Have a wonderful day.